I'm Shirley Coomer, a real estate advisor serving the Phoenix metro area. If you own a rental property and you've ever asked yourself, is this property still working for me or am I working for it? This episode is for you. A lot of landlords assume that if the rent covers the mortgage and there's a little money left over each month, everything is fine. But positive cash flow does not automatically mean strong performance. And it definitely does not mean you understand what happens financially if you decide to sell. Today, I want to talk about who should seriously consider a 1031 exchange, and more importantly, whether your rental is actually performing at a level that justifies the equity you have tied up in it. A 1031 exchange is often introduced as a way to defer capital gains tax. That's true, but tax deferral is only one part of the conversation. When you sell an investment property, there are typically two major federal tax exposures to consider. First is capital gains tax on appreciation. Second is depreciation recapture. Depreciation recapture surprises many owners. Over the years, you've likely claimed depreciation deductions. When you sell, the IRS may require you to recapture a portion of that depreciation, which can increase your tax bill. A properly structured 1031 exchange allows you to defer both capital gains and depreciation recapture by reinvesting the proceeds into another like-kind investment property. There are strict timelines. There are specific rules, and it must be coordinated with a qualified intermediary and your tax professional. But here's the part that often gets skipped. Just because you can do a 1031 exchange does not mean you should. The right decision starts with performance. Let me give you a simple example. Imagine your rental is worth $600,000 today. You owe $200,000. That means you have $400,000 in equity tied up in that property. Now let's say your true annual net income, after property taxes, insurance, repairs, maintenance, vacancy allowance, and everything else, is $12,000 per year. That is a 3% return on $400,000 in equity. When we look at the numbers that way, many owners pause. They thought the property was doing well because the rent exceeded the mortgage. But once we calculate return on equity, the actual return on investment may be lower than they assumed. That's not emotional, that's math. And that's where an asset performance test becomes critical. An asset performance test evaluates current market value, loan balance, gross rental income, operating expenses, capital expenses like roof or HVAC replacement, vacancy allowance, true net income, return on equity, and estimated exposure to capital gains and depreciation recapture if you sell. Most landlords know their rent number. Fewer know their return on equity. And even fewer have modeled what their net proceeds would actually look like after sale costs, capital gains, and depreciation recapture. That gap in clarity is where mistakes happen. So who should consider a 1031 exchange? If your rental has significant equity and selling outright would trigger meaningful capital gains and depreciation recapture, you should at least explore the option. If your return on equity is low compared to the amount of capital tied up, you should explore it. If you are tired of active management, especially in our desert climate where roofs age faster and HVAC systems work hard through extreme heat, it may be time to evaluate whether that level of responsibility still fits your life. If you inherited property and you do not want to manage from another state, that is another situation where a 1031 exchange might help you reposition into something more aligned with your goals. And if you are within 5 to 10 years of retirement, this conversation becomes even more important. As retirement approaches, reliability matters. Simplicity matters. Understanding tax exposure matters. Many rental owners across the Phoenix metro area bought their properties years ago. The loan balances are lower now. Rents have risen. The property feels stable. But when we account for aging roofs, future HVAC replacement, rising insurance premiums, property tax increases, vacancy cycles, and management time, the picture can look different. Then we layer in capital gains tax, then depreciation recapture. Positive cash flow measures income. It does not measure total exposure at sale, and it does not measure whether your equity is being used efficiently. A 1031 exchange can allow you to reposition that equity without immediate tax recognition. That might mean moving from one high equity property into multiple income-focused properties. It might mean consolidating several properties into one simpler asset. It might mean adjusting property type to better fit retirement goals. But I want to be very clear. A 1031 exchange does not fix poor performance. It allows you to move equity from one investment property to another while deferring capital gains and depreciation recapture. The performance analysis must come first. I've worked with many property owners who assumed they understood their numbers. Once we ran a structured asset performance test, they realized their actual return on investment was lower than they thought. In other cases, the numbers confirmed that holding made sense. The point is not to push you towards selling or exchanging. The point is to replace assumptions with clarity. And that clarity should happen before you ever list the property. Because once you are under contract, the 45-day identification window for a 1031 exchange starts quickly. Decisions made under time pressure are rarely the best financial decisions. If you are asking whether you should consider a 1031 exchange, the deeper question is this: is your rental delivering an acceptable return for the equity involved? And do you fully understand your potential capital gains and depreciation recapture exposure if you sell? If the answer is uncertain, that is your signal to run the numbers. I work with property owners in the Phoenix metro area to evaluate valuation, net proceeds scenarios, and performance analysis so they can coordinate intelligently with their tax professionals and qualified intermediaries. Sometimes the result is confidence in holding. Sometimes it is a strategic sale. Sometimes it is a properly structured 1031 exchange. But every good decision starts with clear math. If you would like to walk through an asset performance test on your rental property and understand exactly where you stand before making a move, call or text me at 602-770-0643. Let's replace guesswork with measurable data so you can make a confident, informed decision. This is Shirley Coomer. Have a great day.